Good morning and welcome to the Monday market update. My name is Nash Paradise, joined here by my buddy Andrew Cady, who is slightly, under the weather. So we're going to go pretty quickly, get all the good, because I want to make sure as long as Andrew can speak, we get all the best stuff from him because he always has fantastic insight and tried to tease me earlier on it and started hacking up along. So Andrew, I just want you to don't laugh because laughing's going to hurt. I just need you focused up for when I need you. I'll pull you in. So let's get right to it and talk about what happened last week. Look at the volatility index. It's weird starting the week and ending the week where we didn't really start at 6.10%. We really started a little bit better from the holdover that we got from the previous week, but it was erased in pre-market. So what looks like, this rise and fall, it was legitimate. We had a mixed bag of numbers all throughout the week with a bunch of important information coming in, but ultimately bonds were resilient. We finished strong and headed in the right direction. Let's take a look at what happened last week. And so I can get some insight here from Mr. Cady. As we go through the week, starting off early with, a bunch of meh data followed by the FOMC minutes, kind of a nothing burger there as well. Employment midweek and then Thursday, really a lot of nothing. Came a little short on job. Like it looks like jobs were good. Labor was looking pretty strong. We get into Friday where we have inflation, and this is where things really could have, fallen apart for us with PCE coming in high on the headline, the year over year, the month over month, but there's a good reason why. And so, Andrew, I want you to let us know, why didn't we get too much overreacting to what's going on in PCE?
Yeah, so I think, PCE, keep in mind, this is a delayed report. This was a report that was from December, came out in mid-February due to the shutdown. So this is a delayed report. But we missed, inflation rose 0.4% in a month. That should have and could have wrecked all of the good we've been seeing. But I do believe investors just looked at the report and began to see some abnormalities in there. Obviously, we always talk about shelter. Shelter is still a lag and it's still a problem. But the biggest issue that we saw in the December report that accounted for 0.1%, we would have actually come in line with expectations, was online video streaming services rose 19.5% in a month. The month of December, it sure seems like Netflix and Hulu and Paramount Plus and all of them came together and decided we're doing a price hike. So this, although it'll bleed into the year over year numbers now for the next 12 months, this is a one-time hit month over month. Obviously, they're not going to raise it another 20% in January, but that equated to 0.1% on the core and on the headline reading. We would have actually had numbers that came in right in line with expectations. Should we have not seen that big of an increase in online video streaming?
Interesting. And online video streaming impacts everyone because we're in a world now where you're going to rent it and you're going to like it. You own nothing and you just have a subscription for literally everything. And, that's the life we live. So if those things go up, no one's going to stop doing they may cut out one or two services, but ultimately we're so reliant on all of these. I guess one day someone's going to bundle everything up together and just call it, I don't know, cable. But, some of the younger people here don't know that they grew up, they had their Netflix account from the time they were old enough to watch TV. So that's our life. So that's that's PCE in a nutshell. We missed. We're going up, but are we really? Apparently investors didn't really care. So good news for everyone in the real estate market because that could have gone really poorly. We're going to keep watching that as it is going to impact the year over year for a while. But as we get more into month over month information on inflation, yeah, that's a factor that played into it. And thankfully, investors paid attention to what's going on. Let's talk about what's going on this week here. Pull it up on my side. I'm going to call this a pretty chill week, and it's a chill week until Trump talks. It's never very chill depending on what comes out of the administration's mouth. So we've seen our biggest movements this year so far have come from discussions on Fannie Mae and Freddie buying GSEs, from the treasuries, from getting a new Fed chair. Last year's big market movers were Trump talking about tariffs, and now tariffs are in the news again. It's a Supreme Court decision Friday, and more movement over the weekend with Trump enacting a global 10% and then saying, no, we're going to bump this to 15%. The EU is already starting to respond on that side. So really real data, normal econ data, we don't get until Thursday, Friday. We got jobless claims. Bowman's going to speak, continued claims on Thursday, Friday, PPI. These are inflation numbers. So, labor and inflation. And we're going to repeat that cycle. Thursday, labor, Friday, inflation. But before we get there, we got Tuesday, State of the Union. Anything you're expecting from that, or anything you think that's going to directly tie into what we're doing on a daily basis?
Fireworks. There's always going to be something. When Trump opens his mouth, markets listen. Whether you like him or don't like him, he has the ability to move markets probably more than any single human living in the United States with the words he says. And that is just the truth. So markets will probably be very volatile. And obviously that's a evening speech. So, we can wake up Wednesday morning to really bad news or really good news in pre-market data. So if you're a loan officer and you've got clients that are floating, use caution heading into Tuesday late afternoon, because we could open up way better, or we could open up way worse, or it could be an entire nothing burger once again. And I also think Friday's data, the producer price index, will be a little bit interesting because we have kind of low expectations. The previous was at 0.3% on a year over year, and we're expecting 2.6. Now, producer price index is measuring what producers are actually getting hit with inflation. So things like a Netflix increase in price isn't going to impact the producer price index, but there's room to miss on that. 0.5% and the expectations of 3% or 0.3%. So we definitely got to watch the producer price index. If it would fall in line once again with higher inflation numbers without, things like Netflix streaming jacking that number up, that could be a market moving event.
Yeah, I completely agree. PPI on Friday, we're looking at the previous and the forecast, and it's forecasted to go down a lot. Like you said, year over year from 3% to 2.6. The PPI month over month, came in at 0.5% on the last reading, and now we're forecasting 0.3. It's going to be really easy to miss that on the high side and still be coming down. The question is, will markets treat that like inflation is still coming down if we miss a little bit high? I think they will, because there's a pretty big gap there on, what we're being forecasted, but we'll see. Markets like to move how markets move. But this week, those are your important marks there. The market has shown a lot of resilience in battling back from a few of these negative things. The negative has not hit so negative, and the 10-year Treasury has held its yield pattern. So it's been good and it's been flat. Should be a nice early week for anyone looking to lock something in. I definitely wouldn't be rolling the dice this week. There's a lot of room for things to hit us. But let's move on to what's going on with our Fed funds right here. Love it. It's the same. I would actually say we're moving a little bit and trending a little later on that first cut, which is interesting. It doesn't seem like we need a cut right now with the way inflation has been going. I definitely think they could hold out until July, but if we get any uncertainty going into that June decision, that's never really good for markets. They like to know a little bit more about what's going on. Second cut still, sometime around October. So these have bumped back a little bit from where they were earlier. Doesn't matter, and should anyone care?
I don't know if it even really matters at this point, because this is just all market sentiment. However, I will say it's interesting. Fed member Waller spoke this morning, or yesterday afternoon and had some interesting commentary. And so I'd actually be curious to see if this moves on our next Monday thing a little bit based on his commentary. His commentary basically said, you know, the labor market right now doesn't make sense for, he said it in a lot of words, but basically it doesn't make sense. And his words were, if we would see this last jobs report revised away, which is the BLS standard, he said it could call for a March rate cut. So those are big words coming from Waller. We'll see if it actually impacts this chart at all as we head into the next week. I don't see a March rate cut happening unless we would see massive revisions into negative revision territory, really showing like not weakness in the labor market, but cracks in the labor market.
Yeah, and I mean, you're talking about severe misses at that point, severe revisions, which is not unlike BLS. I mean, we've had them before, but Waller always tends to be a little bit more exaggerated in their comments, to the point that that could point to getting that June cut a little stronger. But a March cut, no, I don't think there's a good chance for that. But could we see June get better? Could we even see April be a possibility on the docket? Maybe. But
Maybe.
we're going to need some more data and some more consistent data. And lately, we've been getting a lot of ups and downs on the data. We've been missing both sides of it. So as long as there's that incongruency in the data right now, I imagine the Fed's going to hold the line. But speaking of hold the line, let's talk about this interest rate line. So love that we've been nice and consistent. We've been living in this world. This world has been copacetic. As we get down towards 6%, we tend to hold a little bit, get a little bit of resistance. We're not going to drop below 6% if we can't get this 10-year yield to get under 4% and hold. Or 4052 this morning. I love seeing that movement. We've been going back and forth between 40, 41, hitting resistance on both sides, which will keep us around 6%, which is a really nice and happy place for people in real estate. I like living here, Andrew. What about you?
I like living here. I wouldn't mind seeing a 5 handle. For me, I think stability over lower rates would be my preference. I would rather be stable at 6% than have a volatile 5.5. But I do think if we could find ourselves over the next 60 days into, say, a 5.75 range, and then find stability there, I think there's a huge psychological shift for the consumer when the interest rate begins with a 5 versus a 6. A 5.99 has way more meaning to it than a 6.125. And it's not that much difference in payment, but there's a psychological shift that happens there. So I would love to see us get just a tick below 6% and find stability. And even if that stability lasts for a year at a 5.8, 5.9, 5.7, that would just be a beautiful, beautiful world to find ourselves in.
Yeah, I'd like a Lamborghini and no back pain, but you're not going to find that. But yeah, I mean, we can hope for and wish for all these things. I would also love some high fives and some stability. Based on a lot of our projections, what a lot of experts are pointing at, they're showing low 6s all the way through the end of the year. But I would agree with you, and that I think there's enough stuff in place right now that we could get into the 5s and hold. As soon as the overnight average hits the 5s, you see the news cycle change. And that's where your average consumer who isn't paying attention to the Monday market update, which you are, and so I'm glad y'all are here, they're not going to know until we hit those 5s. That's where you start to see the advertisements. Mortgage rates are at 3-year low. I'm already seeing realtors getting into the marketplace telling people, hey, this is the year. I didn't say it last year, maybe I did, or the year before, but at a certain point, we're going to see this balance shift where you can't necessarily get $10,000 in seller credits on every deal, where buyers are starting to enter the marketplace again, where enough of these golden handcuffs have been removed with, life happens and people have had to leave these 2.75 interest rates. So that percentage of, frozen mortgages is getting smaller every single month. And we're going to get close to a market where, buyers and sellers have some balance between their leverage. We're not there yet. Buyers still seem to have leverage in most markets, especially here in North Texas. I know they do. But as rates drop and we start to see more buyers enter, that will balance it out. So it would be nice to see a spring with some balance there where people are competing a little bit again. And we're starting to see more sellers. As soon as you get enough of one or the other, we'll start to see, everything start to balance out a bit. Could be a great year, and that's a good reason to be hopeful for these high 5 rates. But we got a big week in front of us. So let's see what Trump says. We'll check out and see what labor and inflation look like. We'll come back and unpack that on Monday and figure out where we're going from here. Anything you'd add?
I think you wrapped it up well. Thank you, guys.
Thanks for your time, man. Take care.